So good afternoon, everyone, and welcome back to the KW Property Management and Consulting's Best Practices monthly webinar for community associations. I'm your host, Tim O'Keefe, an executive director and partner with KW Property Management and Consulting. Last month, we focused on the rising cost of general liability and umbrella insurance. Covered a lot of ground, but not enough. So we came back this month to do it all over again and cover some new topics on the insurance side. With insurance renewals getting much more complicated and costly, today's discussion should bring a great deal of value to our listeners. Today, we will expand on the insurance coverage topic and address the purpose and importance of directors and officers insurance that we often refer to as D&O insurance. We will also tackle the finer print of insurance policies, including exclusions and endorsements, and what board members should know about their coverage. But before we get into the details here, I want to provide my monthly news update. It's my chance to be a news reporter, so I'm a frustrated news reporter. It seems that in each 30-day cycle that we go through, there's so much that takes place. I get to pick and choose what we talk about. So in the past month, the government almost ran out of funding, so we had to get some emergency funding passed by Congress. So fortunately, funds were available to keep the government from shutting down. We now have Omicron, which is a new strain of COVID that is described as being more easily transmissible but less severe than the Delta variant. Also, in the past 30 days, booster shots are approved for Americans over 18 that have been vaccinated for at least 6 months. I got my third shot last Monday, so I'm now as vaccinated as I can be. And in the past 12 months, consumer price inflation rose 6.8%. Not good, but a level we have not seen since 1982. To date, 61% of Americans are fully vaccinated, and in the state of Florida, that number is 62.5% of Floridians are fully vaccinated. So we're doing a little bit better than the national average. So we're ready now to get started. In our next hour, our expert panelists will educate us on insurance policies with a focus on D&O insurance. If you have any questions, please find the Q&A icon at the bottom of your screen and type in your question. We'll do our very best to answer all the questions that you have. We did get some questions in advance of today's session, so thank you for those listeners that sent those questions. Let me introduce our panelists that should look somewhat familiar, and they're both returning from last month's insurance discussion. First, we have Andrea Northrop, who is Vice President and Partner with Insurance Office of America, Florida's largest privately held insurance agency. Andrea also has her law degree, so she's also an attorney, but she's not representing the legal side of things today. We'll let Darrin offer all the free legal advice today. Thanks for joining us again today, Andrea.
Thank you, Tim and KW, for having me. I look forward to it, and Darrin, to be on with you again.
And I'm surprised I had time to hold this webinar today because it took me quite a bit of time to decorate that tree behind me. Darrin Gursky is the co-founder of Gursky Reagan Law Firm that specializes in community association law, including construction, defect litigation, turnover representation, and covenant enforcement. Darrin was also with us last month. Welcome back, Darrin.
Thanks for having me, Tim. Good to see you, Andrea.
Thank you. You also will all notice we have poll questions that are on your screen. You can answer those questions. As we get a little bit deeper into the conversation, I'll give the results of those poll questions. So Andrea, let me start with you because we believe in ladies first on this webinar that I host. Last month, we talked about the increase that many community associations are seeing in their 2022 budgets. And can you remind us all what's driving those increases? Because I've had, since last month, probably 5 or 6 more conversations with a number of boards, and it's like, boy, our numbers are just continuing to go up. So can you remind us why that is the case in this market that we're in?
Absolutely. So it's really a multifold answer, and it's line item specific. So in the past, we've had hard markets, tough markets without much, carrier option in the past, but normally it's in a single line item of coverage like property. After the 04-05 storms and several of the main carriers went out of business and everybody got put into citizens and prices skyrocketed. In this particular market we're in, for the property, it's definitely capacity. So we have fewer carriers that are interested in writing, and when those carriers leave, there's only so many carriers left, and they're taking a strong look at their amount of aggregate in a particular zip code. So in a very dense area, Tri-County Florida, certain parts of the West Coast, Florida, maybe in the Jacksonville area, once they hit a certain amount of coverage already written in that zip code, they're not going to want to write that much more, and there's no other carriers really stepping in to absorb that. And so if you're forced into the marketplace, carriers are basically naming their price and terms, but we're seeing it simultaneously in the general liability market and the directors and officers market and the umbrella market. So the umbrella market alone, we've only had a handful of carriers. We've got a major one who's non-renewing a good portion of all their association business effective January 1st. We've got another one that doesn't want to write any new business in Tri-County after January 1st. And we have another one where 2 or 3 years ago, they were writing up to $100 million limits, and they really only want to be writing $5 million limits now. So you factor that in, there's more communities fighting for a smaller amount of insurance that's available, and that is causing the rates to skyrocket.
So one thing that I know not everybody understands is things that happen around the world affect what we do in Florida. So, you know, with the tornado that just came through the Midwest and the South and created so much damage and devastation, what's the impact that that would have on Florida insurance markets? Because, you know, one of the things we hear is global warming, those kind of conditions happen because of global warming. So does that mean hurricanes will be worse? And what does the impact have in Florida?
Absolutely. So yes, so we might buy local on our insurance with a local agent, but it's being priced globally. And so those national carriers, those that are writing Florida, they're writing Texas, Louisiana, Mississippi, the Carolinas, and in the Midwest. So if they're experiencing losses there, that is going to be passed along to their other clients that they have. They're going to have to purchase reinsurance. It's basically the national insurance program is buying its own insurance program on an international basis, so that if that becomes more expensive, they're going to turn around and pass along those costs. So if they realize losses from Hurricane Ida, the flooding events that occurred, the storms, the tragic and devastating storms that just came across Kentucky, but we're also seeing it from the wildfires in California for the last few years. We've all started learning the Greek alphabet, partly from COVID and partly because we've run out of letters of the alphabet for named storm seasons. So if you look at Louisiana and getting hit with, I think it was 6 named storms in one season, and then you look at just the sheer size and strength of the storms that are coming across, it definitely has the carriers paying notice to the fact they're getting stronger and they're staying at that strength a longer period of time.
Now, when we spoke earlier this week, Andrea, you mentioned that there have been a lot of changes in the past 30 days in the insurance market too. So not only does the news change, but things are pretty dynamic in the world that you work in every day. Can you talk a little bit about what those changes are and how that coverage affects properties that we all deal with?
Absolutely. So it's an ever-moving target when we're placing insurance, but there's a real line in the sand as far as a January 1st is concerned. And so when we're shooting for placing coverage that's going to start the 2022 year, we're seeing some major differences from the carriers, especially in the general liability space. So we're seeing a significant amount of non-renewal coming in from our traditional markets. You know, one of the major players in the games has decided, okay, on our admitted paper, we are going to be non-renewing a good portion of our condo book, and they're going to be minimizing what qualifies for coverage moving forward. So this is partly where they say, you know, under 5 stories, maybe they don't want anything within a mile of the coast. They want things that are only built after 2002. If you think on average, you know, of the carriers and the condo associations throughout the state of Florida, trying to find things that are built 2002 or newer that are not within, let's say, even 5 miles from a coastline, that's going to be a lot more difficult. So when you're seeing a huge player in the marketplace, maybe non-renew half of their book, you're going to, again, create that void, and we're going to have to find new carriers to place you with. And what we're seeing with those new carriers who are stepping into that, more often than not, are those excess and surplus lines carriers. So they're not admitted, they're not participating in FIGA. So you really need to pay significant attention to the forms, because the coverage that you can get to replace it, if you can get coverage, and that's another issue for many associations, if you can get replacement coverage, it's coming in, you know, sometimes 6, 7, 8 times as much, depending upon the loss history of the association. And it's coming with a significant limitation on coverage. So the exclusions that are being put into place, a lot of them are operating like warranties. You know, there's a lot of I's dotted and T's crossed that you need to get into the details of. It's not just, oh, we replaced coverage, we had that carrier, now we have this carrier. You probably have a lot less coverage than you did before, and a lot greater obligation on the association to make sure the coverage applies.
And Darrin, how are you getting involved in these market conditions and changes that your clients are talking to you about the impact of insurance on them?
Well, so, Andrea brought up a very good point there, and that's when a carrier comes through and will not renew the policy, and you're stuck with maybe a non-admitted carrier. I always am very extremely cautious with clients with respect to it, and I make sure that they document across the board meeting minutes, as well as proposals presented by the broker to confirm that no admitted carrier would provide a policy, because I think the board has a fiduciary obligation to have an admitted carrier insure the property based upon some of the conditions that Andrea just mentioned. But also in terms of that as well, and what we're seeing is because of the market condition, as mentioned, and how the carriers are essentially calling their price, but they're also dictating the terms as well. So now with these events that are occurring, whether it be an unfortunate condition with your property, or it's something with the nature of a natural disaster, or whether it just be the location of your tower and what potential foreseeable event may occur in that particular area, now carriers are becoming extremely critical in reporting, and not just necessarily reporting a loss, but reporting any potential issue that may result in a potential loss, or any potential issue that may give rise to another issue that gives rise to a loss. And if you don't report those issues, then they're rejecting claims. And so there are other policies now that are almost coming into the woodwork, we'll call it, or coming into the marketplace, where it's a policy to protect you from your own policy not picking up a claim. And we're seeing that in the marketplace too. And it's almost a way of these carriers generating additional revenue. It's a insurance expense that is not identified in the budget because it's an unknown foreseeable cost that you would have no idea. And now associations are being put in tight situations budgetarily because they did not anticipate a carrier dropping them or a carrier having exclusions under the policy. Just for an example, obviously here in Florida, with respect to the unfortunate events that happen in Surfside, now all the carriers are not only requiring that a property assessment condition report be presented, which never would have been having to provide before, but now you have to routinely also provide that report either annually or biannually, and it has to be substantiated by an engineer of record signing off. In the past, all that was really necessary for a property claim was an appraisal. Now it's becoming a lot more significant. And plus, when you execute your form for insurance, you have to disclose any and all potential claims as well as the condition of your property. If there is a situation relating to the condition of your property that may have been identified prior to that policy period, and the carrier was unaware of that at the time of the application, then they won't cover that claim either. So the carriers are coming extremely stringent on those, like Andrea said, the dotting of the I's and the crossing of the T's, and they're looking for any reason to reject the claim, and at the same time too, any reason to increase your policy and increase your deductible. And that's becoming extremely tough for these properties.
So I think one of the things you said at the front end of your answer, Darrin, which I think is really important, is have these conversations in board meetings and have the meeting minutes documented so that nobody can come back later and accuse the board of not following the right process or understanding what's available to them from an insurance standpoint.
Well, it's sort of a loaded question there, Tim. Sometimes you hope your agent is coming forward and is expressing to the board the realities of the policy, and you hope that the management team and the board is discussing with their agent the issues that are impacting the association, which could affect the policy. A lot of times we see it more on the front end in terms of a board saying to its agent, we installed hurricane impact windows, so can we get a deduction on our premium? Or we just went through a restoration project and our property has a clean bill of health, so do we get a reduction on our policy? So a lot of times the thought process is more on, can I get a reduction on my premium versus, hey, this is a situation or a condition my property is experiencing. How does that impact my policy? We rarely see that end of it. We more or less see the front end of that issue, at least in my experience. But now I think agents have to become more involved. I think it's only fair to associations that the agent gets more involved and asks these critical questions. And if they're not asking these critical questions, I think it is incumbent upon managers and board members to ask agents these particular questions of what is affecting the policy premium, what's affecting the deductible, and where are the specific exclusions under my policy that I know now and I won't find out later on. Those questions are rarely asked. The more questions, like I mentioned, are what type of situation can I do to limit my policy premium? That is more or less the question that generally gets asked.
Andrea, are you finding that you and your agent are being asked to go into more board meetings now and explain how this works than in the past?
I wish we were more, would be the better answer. More often than not, the natural inclination is to go towards, discussing the premium and the bottom line. And if we can get there, if there's enough time, because this is becoming an issue with the carriers they have so many submissions by the time they get the quotes put together and generate the forms, trying to schedule the necessary board meetings and the timing. But if we can get everybody together and go over and say, yes, this one policy is 8 times more than expiring, and the other one is 10 times more than expiring, the natural inclination is, okay, well, let's lock down the one that's only 8 times as much. But then we can sit down with them and spreadsheet at least, here are the highlights of the differences between the two, because the one that's 8 times as expensive is basically worthless, because there could be so many endorsements on there that remove coverage that's afforded under a regular one that it really isn't even an option, even though it's a quote on the table. So those discussions should be had, which is, why is there a price difference between them? What coverage are we giving up to get the price difference between them? How do the deductibles apply? What is it if we've got this specific need versus that specific need? So I think it's going to become necessary if they're willing to listen and take the time, but that would be the, part of the fiduciary responsibility of the board to start asking those questions now and saying, what are the differences between this year and last year's policy?
Well, hopefully this conversation today can be eye-opening then for some of our listeners to say, call your agent and bring your agent in and have these discussions, because you're not charging them to come in and consult with them. You're there to educate them on how their policies best suit them and work best for the association and all the owners there. So I think it's a great opportunity to educate people on how the insurance world actually works. And, look, we got kind of lucky, I guess, for 7 or 8 years where policies came down and, the number of disasters was more limited. And that's all kind of reversed in the last couple of years. So this is a good opportunity to learn about this.
And like Tim, like we mentioned too last month, if, hopefully people heard it, these major catastrophes, and in addition to the COVID shutdown, and we mentioned it last time, all the insurances tie into one another. So we have the issue, like you mentioned before, with in Kentucky with the tornado. That's just a part of the carrier they're leveraging their own risk, and their own risk leveraged with that policy is tied to some other policy that impacts risks associated with hurricanes. And all of it is tied together. So that's why the premiums are going up. And so the more we see with the fires and the tornadoes, and irrespective of whether or not a hurricane comes through, it still affects us too. So that's problematic.
We want to spend some time today talking about directors and officers insurance. So, Andrea, could you define what D&O insurance is and the purpose of it?
Sure. So directors and officers insurance is primarily going to be there for the purpose of defending the board and the association itself for its enforcement of its governing documents, the enforcement of the statutes, its bylaws, the decisions of telling somebody no, they can't paint their front door purple, or they can't drive that type of vehicle or have that type of animal, or whatever it may be. So it's there to protect those that are serving in that capacity to run the corporation. But what it's not is all encompassing. It's not a full document that says whatever you get sued for, you're going to be covered. And that's going to be a big difference, because directors and officers policies are becoming limited, maybe not as severely as we're seeing on the general liability, but they're definitely more limited in nature. I think the one that probably got highlighted the most in the last 2 years was that directors and officers policies have exclusions primarily that say arising from or related to bodily injury, illness, disease, death, and sickness. And so if you're looking at a claim that's going to come in and where the board said, okay, we're aware of a situation that we've got some rebar exposed or some spalling concrete, and we know we need to fix it, but they do nothing, and then it falls on somebody's car. If they file a suit against the board under the D&O for failure, to make the decision to make the proper repairs, negligent repairs, the directors and officers policy most likely is going to say, we're going to deny coverage because it triggers the exclusion of property damage. And when you go through it, you start looking at all of the different things that are going to be excluded that tie into those decisions. One of the things that we highlight is as it relates to like breach of contract. Not all policies cover breach of contract in any form. It might be a complete exclusion, but for those that do cover it, breach of contract is normally only offered for defense only purposes and not loss. So the carrier says, okay, it might be a legitimate claim that, your contract says you 30 days notice to the landscaper, and you say you gave him 30 days and he says you gave him 25, and now we have to go to court and fight it out. But if you end up being liable at the end of the day, the directors and officers policy is not going to cover any loss. They're going to say, well, that was on you. You owed them the money. Turns out you actually owed them the money, and you still owe them the money, not the insurance carrier. So that's going to be another big one. So there's a lot with regards to a directors and officers policy, depending on how much time you want me to take from Darrin, that I can go through.
Well, no, I was going to ask you, what under the policy would give rise to the D&O covering the loss versus just the duty to defend?
It's going to be carrier by carrier specific. So almost very few carriers are in the community association world are going to offer loss coverage on a breach of contract, because that'd be morally disincentivizing to them to go out and breach contracts, because there's no downside for the association, if I'm understanding your question correctly. Or are you asking what other types of things also do not have loss?
Well, so generally, and I'll say this, for the most part, a claim against an association relates to breach of contract, whether the contract is the landscaping contract, or big picture, whether the contract is the declaration of restriction and covenants or the declaration of condominium. And those are the type of claims primarily that we see D&O coverage pick up that defense of the claim, but rarely do they accept the loss. So if it's a breach of a fiduciary duty for failure to enforce the governing documents, are there any policies that would pick up that loss, or is it primarily only a defense type claim? And the reason I'm asking that too is because, and I don't want to get ahead of Tim on this, but it correlates to one of the poll questions, is the litigation coverage type policy, and which is almost similarly situated type policy. But again, it doesn't cover a loss, it only covers the defense. So why would we recommend to an association to get that? And so it's a couple questions in one, but that's something that I'm concerned about. And I think that's a very good question for the audience to sort of understand.
Absolutely. So there are some D&O policies that are still out there that only cover monetary loss. And there's very few D&O claims are actually monetary in nature. Very rarely is it, I want you to do something or you're going to owe me X amount of money. It's normally you didn't enforce the governing documents, or I don't like the way you enforced them, or your failure to enforce them resulted in X, Y, and Z. So breach of contract itself under most policies is not going to be treated the same way as a fiduciary violation for failure to enforce the governing documents. Normally a contract is more traditional contract, two parties written agreement together, that you would see more in a vendor type situation. And in those scenarios, you can have dollar amount judgments that are going to be attached to it that would be covered. For those that are going to be defense only, if you're looking at maybe a fair housing violation or an ADA violation, those would be defense only. If you end up getting fined at the end of the day, if you end up having to make a physical modification to the property, the directors and officers carrier is not going to pay for the sidewalk to be widened or for a ramp to be installed or for an elevator to be put on. So those would be differences there. The the gap policies, which is what I think you're referencing. So those have to be, for most carriers, have to be lawsuits. They can't just be a traditional claim. So under a directors and officers policy, a claim is often defined as a written demand for monetary or non-monetary relief. So that's super broad. That could be, I send you a letter that says, I want this, and if nothing happens in 30 days, then you're going to hear from me again, or I'm going to file suit. You have a claim when that letter is first sent because that's a written demand for relief. The other policies require usually to be a lawsuit itself, and then even then they're only going to cover the legal defense, the attorney's expenses, whereas under a definition of defense under a directors and officers policy would be more broad. Those might include the expert witness fees, those might include the court costs and the filing fees and the deposition costs and things of that nature, which would be picked up under the D&O, as opposed to one that literally only picks up the attorney's hourly rate.
Interesting.
So what we were, some of the discussion that we're having here, we're using terms like in exclusions and endorsements. Andrea, could you take us back a little bit and define what is an exclusion, what is an endorsement, and what's the real world practical approach to the, in the D&O policy, what we're talking about with those terms? Absolutely.
So for as broad as a policy is, if it's specifically excluded, that means it's going to pull back coverage. So if it says, this policy is going to respond to an insured, then it's going to define an insured, then it's going to define a wrongful act, and then it's going to define a claim. And that's the more broad setting. And then from there, every exclusion is usually whittling that down. And so then if it says, except we're not going to afford coverage if it relates to an ERISA claim, or if it relates to, like we said, ADA fines, we're going to cover it, minimize it, bodily injury, illness, disease, death, sickness. When it's taking away coverage, there's a lot of instances where those board decisions then become more thoughtful when you're making that decision. So if you're saying, okay, we've got somebody who continually reports that we have a leaking roof, and we have to decide if this is going to be the year we replace the roof. If you're looking at your directors and officers policy, and they file a suit against the board under the D&O that says, you knew, you were aware it resulted in bodily injury and property damage, the carrier is going to look at that. The exclusion is going to kick in and say, no, there's absolutely no coverage at all whatsoever. We don't have to defend. We don't have to respond. You could look to the flip side under the general liability policy, and it's also going to have a definition of an occurrence, which is sudden and accidental. And so if they see that same information that you knew and it was progressive and ongoing and continuous, then you may have no coverage at all. And that's really important when you're deciding whether or not you're going to serve on the board, and then the decisions you make while you're serving on the board.
All right, Darrin, I'm sure you get pulled into some of these kind of things. It's like, I know we paid for insurance. How come it doesn't cover us? What's the role you play in that?
So twofold. Anytime there's an incident or an occurrence, as Andrea just mentioned, comes about, client calls me up and says, what do we do? And immediately I advise them to inform the agent, depending, most likely in those situations. Not every single scenario requires putting the agent on notice, because like we talked about last time, there's a gentle balance between making a claim and creating a loss history on your insurance policy claims, and because that loss run travels with you. So there is a delicate balance, because you want to have coverage and you don't want to be denied like we're talking about, but so you want to put on record most of the time of a claim or an occurrence. And when the carrier comes back, they'll assign the claim to an adjuster, and then the adjuster will write a position letter identifying whether or not there's coverage under the claim and whether or not they're picking up their claim based upon the terms of the policy, or whether or not they're picking up the claim with what's called a reservation of rights, meaning they are picking up the claim, although under the policy, they're potentially, if facts come out relating to the claim, they may have the ability to withdraw coverage, withdraw picking up the claim, and also seeking reimbursement against the association for any expenses that they incurred as a result of their picking up the claim in that interim period. And then the third option is they deny the claim. In the instances of a right of first, we'll call reservation of rights, or in the case of a denial, generally I review why they provided such a position. And when reviewing why they provided such a position, I also, in conjunction also with the policy, a lot of times I will write back to the carrier and put them on notice of why they have to cover the claim or why their reservation is flawed. And in both circumstances, you have to do that. And if you don't do that, then you're not putting your position in writing. So that's number one, a flaw, puts you behind the eight ball. And also two, you want on record that in the event something adverse occurs to the association, you have the ability to go back to the carrier to say, hey, you withdrew coverage or you denied this coverage. And in both circumstances, you were wrong and you breached the terms of your policy. And now I will be seeking against you reimbursement for my damages as the association. Because remember, we paid for this policy and so we complied with the terms of the policy. And now you breached the terms of the policy by not covering my loss. And in those circumstances, that's what they call a first party claim. I'm sure most people have heard about the term first party claim. That means it's you pursuing a claim against your own carrier for failure to cover that claim. So that's where really my involvement comes in. And it comes in a lot, more often than you would think. Many times, because you pay for the policy and there's a general understanding of what you believe that policy to be, when coverage is denied, it's always rather shocking. And also, it also gives rise to questions from the agent as to why it was denied, and questions as to representations, maybe even from the carrier, as to why those exclusions were not presented to the association in order to make an informed decision.
So, Andrea, when we're talking about, this sounds like, gee, this is a huge policy and can affect boards and associations in so many ways, but D&O insurance isn't that expensive. So can you just talk about a little bit that the expense and how does it get calculated? Does a 3-person board cost less than a 9-person board? Does a 40-unit community cost less than a 400-unit community? Like how is D&O, is it just one size fits all?
Definitely not one size fits all. So there's probably going to be about 5 pages worth of questions that are going to lead ultimately to the generation of an initial quote. But to your point, they're going to want to know how many board members there are within the community, and they're going to want to know how many homes there are within the community. There's going to be a difference in condominiums versus HOAs based upon what they're going to fall under from a category perspective. They're going to look at their prior loss history. And interestingly enough, there are carriers who want to know the average value of a home within the community because they have found that, you know, I've got one carrier that says, okay, if the average value of a home is more than $2 million in that community, we don't want to write in that community because they found them to be more litigious with the ability to keep the claims going because they have the financial means to fight and continue to fight against the board when they don't like something. So there's a lot of different factors, but primarily it's going to be the size of the community itself that is going to be the largest indicator of whether coverage is going to be expensive or not. I've had a little knock on wood to myself when you said D&O coverage isn't that expensive, because it's another one of those where we're getting fewer and fewer carriers. So I hope it stays that way. But for now, I mean, you're getting $1 million on a policy year for coverage for a relatively small amount of premium.
Is it safe to say that the typical D&O policy is going to be somewhere between about $2,000 and $3,000? Is that an average number?
I would say so, depending upon, the number of units. If you're starting touching upon, 400 units, 500 units, 600 units, you're going to start seeing a higher amount. It's one of those where it's either very small or it's very large. So you either have a very small premium and maybe only $1,000 or $2,500 deductible, and you might be able to get a first dollar defense endorsement on there. So the deductible only applies at the time of actual loss or settlement, and not at the start of every claim. Or you're not going to be able to get coverage. And when you can get coverage, it's going to be $30,000, $40,000, and you're going to have a $50,000 deductible, and it's going to be applied at the start of every claim, defense included. So those are kind of the broad ranges.
Compared to general liability, umbrella, wind, it's not nearly as expensive as those are the big ones, right? Those are the big buckets that we fall in. So Darrin, when we're talking about exclusions, like what do you typically see from a practical standpoint when there's an occurrence on a property and the board pulls out the insurance policy and they call you and they say, this is covered, right? And like, what are the typical things that people don't understand about the exclusions that you deal with when boards call and talk to the attorneys about this?
Well, one of the biggest exclusions, we talked about at the very beginning of this, is in those cases of a breach of contract, how come the loss is not covered? That is a very, very hard concept to understand, because I just bought this insurance. Insurance covers me, generally, people believe, when it's a loss. But insurance doesn't always just cover a loss. It sometimes just covers the claim, but not the loss. And that's a true basic one with respect to a breach of contract claim. But what other policies that we see that do not cover it is a lot of times we'll see defamation claims. Defamation claims are generally not covered. And that's critical for people to understand too, because if you disparage or slander another fellow unit owner as a board member, be prepared that that probably is not covered. Another big issue, which is also generally not covered, is mold. Mold is always an exclusion under these policies. And sometimes nowadays you can maybe get a small mold coverage of like $10,000 on some of these property policies. It's limited depending upon the carrier, but generally mold is an excluded coverage term as well. So in the event of, let's just say, and I see this a lot too, there's a breach of declaration claim, breach of fiduciary duty. The board breached its duty by failure to maintain the common elements. I have water intrusion into my unit, and as a result of the water intrusion, I have mold. Once the carrier sees mold, claim is rejected. And that becomes problematic because then the association has to cover it all out of pocket. And so those are two of the bigger exclusions I see. And so there's the loss, defamation, mold. And then when you really get down to it too, the existing condition is also seemingly a reason, or failure to timely report the claim. Those two are also issues that come up for rejecting a claim. Then let's just say they do pick up the claim. Now what happens is this: when they pick up the claim, then the carrier will ask you for a slew of documents, a slew of information, want to interview everybody. But remember, they picked up the claim. Sometimes the association may not have those records that they're seeking. They may not be able to get it to the carrier within the 48 hours in which the carrier wants it. And then what happens is the carrier sends a letter saying, you're breaching your duty under the policy by failure to cooperate. And you're saying, what are you talking about? I'm cooperating. I made the claim. I'm trying to get you everything. And the carrier's like, no, you did not get this to me timely. Because you did not get those documents or respond to my inquiry timely, you failed the cooperation clause and we're rejecting coverage of the claim. those are primarily the reasons that I see for denial of claims or rejection of claims or issues within a claim that get excluded. And they come up all the time, and it generally leads to a fight or a dispute between myself and the adjuster. And many times, the carrier seeks to resolve the claim amicably in an effort to avoid the association pursuing a first party claim against it. But going back to what Andrea mentioned at the beginning, nowadays, because the carriers are so limited, as soon as you upset a carrier, it's grounds for them not to want to renew you next time. And that's happening a lot too.
So Andrea, when Darrin talks about some of these different exclusions, how much time do you typically have to file a claim? Because one of the reasons why you might not get coverage is because you didn't file timely enough. What is the proper time frame to file a claim when you have an event?
It's going to be, normally it's going to be defined in the policy itself, and the definition within the policy tends to be not very great. It usually says as soon as practical, as soon as reasonably possible, as soon as you become aware. So those can be very broad, because we have to have discussions with people where we say, it's not when you get a lawsuit. So years ago, definition of a claim was service of suit, was very easy to know when you had a claim. You got served with a lawsuit, we've got a claim. And now it's, well, the letter came in and it hit the admin's desk, or maybe it got shoved under the door of the president's unit, and it took a while for them to come back and get it and then turn it over. There's some wiggle room within those initially. Where an association is really going to get themselves in trouble is when they start the back and forth negotiations, or trying to self-defend, or even engaging their attorney to start representing them in the action. And several months go by, several positions have been taken in letters, and then it looks like, oh gee, we're definitely going to go towards litigation. And then we get a notice, and the carrier is going to look at that and say, well, this references 4 demand letters and communications that have been going on back and forth since a year ago. Why weren't we put on notice? That's when it became a claim. And that's where associations are really going to find themselves in trouble, with a potential of a carrier saying, I was prejudiced in my ability to respond and adequately defend this. And so they might want to deny it at that point.
And so we also were talking about, we've thrown terms out, the endorsement term. Can you define for us, Andrea, what is an endorsement? How does it apply to a policy?
Sure. So an endorsement could be an exclusion, even though it's not called an exclusion, because it's being added on to the primary forms of the policy, but it in and of itself could be taking away coverage. And so you could have a policy where included within the definition of an insured, it may not include a community manager or management company. So you need an endorsement to the definition of who is an insured to bring in a manager so that they're included within the defense for insurance purposes. It might need to be a broadened definition to include committee members or volunteers in whatever capacity they may be serving. So we might need to add some of those endorsements in where the carrier might be giving back just a little bit of coverage. So in one particular carrier, breach of contract in the main body of their exclusion as it's filed with the state is a full exclusion, no coverage whatsoever. They add an endorsement back onto their policy to show breach of coverage for defense only purposes. So it could be used by either definition. You might have a scenario where the bulk of the policy excludes 16 forms of coverage, and endorsement might give you back 8. And then you could see the reverse. You might have only 8 excluded in the body of it, and you can have an endorsement for whatever reason that says if it triggers A, B, and C, now we have less coverage.
Is collapse endorsement common?
On property policies?
Yes.
Built into the form? Yes, it is. It's got a Florida form, and it is, it's very specific if you read through it. And there's a lot of information that's included in there. And hidden and unknown really are the 2 big key words that you need to know, is when you actually usually have a collapse, it's the hidden and unknown. Given the unfortunate nature and the tragic nature of what happened down there, a lot of those carriers made those decisions as they made them to pay in full. But the language that's in there is very interesting if you sit down and read it for collapse.
Right.
How much of that?
I have read it, and I will tell you it is a little confusing but the general sense is what everybody would expect.
How much of the, the decision to pay 100% on the collapse and surf side was more for the publicity of it or the goodwill behind it versus what an insurance company would have typically done, trying to dig into the policy and saying, well, that's not really what it says. How much of it was just, it's goodwill to do this, we better do this or there'll be outrage.
Having not been a direct part of it, it would only be hypothetical in my mind. For most carriers, I think when you've got something of that magnitude, I mean, obviously there's concern for the families that are involved, and even the amount of insurance that was carried was never going to be enough to touch and repair those lives that were lost. And so I don't foresee that they wanted a fight in that particular instance, but I was not. Again, that's purely hypothetical, and I'm guessing because I have no involvement in that whatsoever.
Well, what I was going to say about that, Tim, though, because that brings up a good point. I think to Andrea's point, it was easier for them to pay out as opposed to go through that fight, understanding that, and everybody should also be aware of it, the insurance carriers look to other parties who are at fault that created that loss. So it's much easier in that scenario for the carrier to pay out, recognizing that they could subrogate that claim potentially against other parties where they think they could get or recoup the money they pay out. And that subrogation claim in their mind probably was much easier of a fight than not paying out, based upon putting aside the sensitivities, but the type of fight it is would be much more in their favor versus the fight of paying out the policy. That's
a good point, Darrin. So Andrea, what are first dollar endorsements? That's a term I've heard before. So what is first dollar endorsement? Well, how does that play out in real life?
Absolutely. So there could be a major difference for an association in their directors and officers policy with a first dollar endorsement. So if you've got two policies side by side and they both offer identical coverage as far as what's included or excluded, and they both have a $2,500 deductible, you would think they would be equal between the two. But one of them, without a first dollar endorsement, says that the deductible is going to kick in as soon as the claim is filed. So for every $2,500 of the first defense cost is going to be billed back to the association that they're going to have to pay. So if they had 3 claims in a year, potentially there could be an additional $7,500 out of their pocket in those 3 claims for their deductible. On the flip side, the first dollar endorsement for one carrier, it usually runs about 10% more in premium. So $2,000 premium, $200 more, says that deductible is only paid once there's a final judgment or settlement against the association. So if they had those same 3 claims, like the earlier scenario, but they won all 3 of them and there was no loss or judgment against them, they would have never paid that $7,500.
Darrin, any comments on that?
Well, everything she said, that's how it plays out. There's nothing really to it. A lot, going back to it too, a lot of times the people don't understand that too. When you make a claim and you have to pay out a deductible, how is that a deductible attributed? And, it's attributed obviously to paying out either the first portion of that claim, and or if there's attorney's fees associated, like in the D&O type defense type claim, the money is attributed to those first set of attorney's fees that are incurred.
And so, Andrea, how has D&O insurance changed or been affected by the pandemic that we're in the middle of? Because you talked earlier about how exclusions might be bodily injury, sickness, disease, death. And now you've got this pandemic that I guess it's been thought of before and it's been put in policies, but I don't think anybody thought it would be what we have today. But how has that played out in real life with boards and the way it's affected language in D&O policies?
Absolutely. I mean, we definitely have more associations that we're looking at what's included in the policy versus what's excluded in the policy for making decisions. So you notice in there all of a sudden, your wrongful entry, your invasion of privacy, your humiliation, your emotional distress, all of those other exclusions that could be triggered by it came to the forefront because we got such interesting types of claims that were coming in. So if the board either, enforced a mask mandate or didn't enforce a mask mandate, we were getting claims on both sides. People who didn't feel protected for what they should have been implemented versus those who didn't want to abide, people who wanted the amenities to be opened and the board having to evaluate, all right, if we get a claim, this is what I call suable versus liable discussion. You're far more suable than you are liable. The question is, do you want defense for when you're sued as opposed to just coverage when you're looking at liable? So if it says it's got an exclusion in there for bodily injury and the board's decision is to open up the sauna, whether the person can actually prove they got COVID in the sauna at the time is going to be toward the liable, but to defend the suable, the directors and officers policy is not going to be the one that responds if you've got that exclusion for bodily injury. So they're evaluating all of those notices about having to turn over, can we say if people are vaccinated? Can we make them be vaccinated? Can we publish records of people? That's where we start looking in the invasion of privacy and those other types of claims that might be excluded. So there was a lot of information that came to the forefront, but we also saw more claims. And I think that we're going to start seeing that trickling effect moving forward from those carriers saying we don't want to be involved in community associations as much as maybe we've been in the past, or we're going to charge a lot more and have them put a lot more involvement into the game, higher deductibles, fewer first dollar endorsements, so they feel the pain of the claims more so.
And I was going to say, not to segue into some tougher issue, and you can bring it back, Tim. A tough part about being a board member and having to consider these issues that we're talking about today as to how your policy works and claims that will be picked up and questions to ask your agent and concerns that your lawyer should point out with respect to these issues. A lot of times people join a board of directors because they want their property to look better. They want, they're looking for the maintenance to be upkept better, or different pool furniture, or the valet to get your car quicker, or the employees to be nicer to the residents, or just to things of that nature. And that's what makes being a board member very difficult, because not only do you have those concerns, but then you have to think about these technical aspects of coverage and how liability is attributed under a policy, and whether or not the association is fully covered, and what types of exclusions are we susceptible to. And that's what really makes a board member be challenging, and because some of these things you just would not think about it because it's maybe not necessarily part of your normal business life. And, I want to say, just listening to this through, even though I'm part of this webinar, it's nice that KW puts this together, because it really gives board members an educational tool for issues that they really need to think about, notwithstanding the fact of, I want to say, natural issues that you would just generally think of as a board member living in your home versus something like this.
Mm-hmm.
Well, and we need board members, and the whole purpose of D&O insurance from our perspective is that it protects board members. We've talked a lot about what it doesn't cover and, endorsements and exclusions, but the reality is it's there to provide protection to the board, so that if you're, a good board doing what is, common sense, what's right every day, using good judgment, this policy is going to defend that board. You're not going to be personally liable. Now, if you go out on your, off on a tangent and you're the lone wolf doing things that aren't necessarily legal, then we try to reel you back in to say, look, don't do something that could make you personally liable. And I think that's part of the message today for us, is to say, look, this is good. D&O insurance is good. It's not that expensive. It should give board members peace of mind, let you rest a little bit, because you know that you're going to be covered making everyday kind of decisions for your community. And Darrin, you probably deal with that all the time. Like, people probably ask that question all the time. What am I covered with? What can I do? What can I do?
I want to say, not only do I get that question all the time, I get that question a lot of times from prospective board members. So a lot of times board members or I should say unit owners who prior to putting in their intent to be a candidate for a board member position at an annual meeting will ask the property manager if they can reach out to me just to say, what type of coverage do I have? I want to say that question gets asked more than existing board members who are in place, just to say, hey, what type of coverage do we have? You know, because at that point, it's almost too late. You're already in the seat. But I do get the question primarily from prospective candidates. But you know, going back to it, I get the question a lot. I want to say I get the question probably once a week, and you know, I'm glad I get the question. It's satisfying to request a copy of the policy, knowing that a board member is being prudent in trying to understand what their coverage is. Because that just makes me think they're being responsible to the rest of the community in terms of their concerns. And that's always a responsible board member.
So somehow or another, we're getting close to 4 o'clock. So we've almost chewed up a full hour. This time just flies by when we're having good discussion, but we've got a number of questions that came in. So if we could try to spend maybe 15, 20 seconds on answers to these questions, I'd like to kind of rip through them if I could. So Andrea, I'll start with you because John is asking the question, how can an association obtain competitive insurance quotes in the face of having to engage a new agent of record in order to obtain other quotes?
The short answer is it's very difficult. It's kind of like assigning your property manager to go out and get roof bids and then wanting to go to another property manager to go to those same roofers and get the same bids. You know, the roofer is going to be like, well, who am I supposed to be responding to here? That's the role of the broker. So the broker should be providing to you marketing results. And that's going to be the key to understanding what 30 carriers did they go to? What were the responses? What did they say? Because the likelihood is all the different agents out there are probably licensed with the same carriers and would be getting the same results from the individual. So just really interview your prospective agent and decide which one's going to represent you best as a consultant.
Okay, thank you for that. Stuart in Pinellas Park said, historically, our insurance renewal occurs in mid-December, about a month after budgets are voted on. How do we get the renewal date more in line with our budgeting process? Ideally, they'd like to have the end of the second or beginning of third calendar quarter is when they would like to have their renewal date, but it's in December now. How do you do that? Do you buy up more months? Do you buy down fewer months and try to align it? How can you do that, Andrea?
In the soft market, we could buy more months. In the hard market, you know, sometimes you don't want to cancel and rewrite early and give up 3 months of good pricing when the next renewal is going to cost you more. It's carrier by carrier. Each carrier is going to decide whether they're going to sell you long-term, whether they'll sell you short-term, whether they won't sell it to you at all and you're just stuck. But normally it would be done through a cancel rewrite process into the month that you want your renewal to take place if they'll allow it.
Okay, and then a question from Stephen, can a condo association require residents of a high-rise to carry HO6 insurance? And if so, how do you monitor that? So explain what HO6 insurance is first and then answer the question, please.
Gotcha. Well, I can tell you HO6 is going to be a condo unit owner's policy. So it's going to be that portion of the interior plus the unit owner's liability. So their property and their liability for the inside, but whether or not they can require it technically would be a Darrin question because it's either statute or governing document.
Right, statute. Well, so it's not in the statute. It was at one time in the statute.
That's right.
A number of years ago, but they removed it. Probably, I want to say now it's probably been about 5 or 6 years. It was probably removed, and it was only in there for a short time. I want to say for about 2 years. And the reason they took it out is because they wanted to make it more community association specific. You can amend your governing documents to have the requirement. Now, one of the questions that Stephen says is, and if so you have the requirement, how do you monitor it? Well, you know, an insurance policy is an interesting type of tool because it's essentially a month-to-month type contract. Even though you have annual policies, you can elect to pay the policy monthly, and if you don't pay 1 month, they'll cancel you the next month. That happens a lot. And now HO6 policies are rather inexpensive policies as well, comparably, unless you can add riders to it and you know, they can become a lot more money. But the reason they're relatively inexpensive is because you already have all the other types of policies associated with the property, windstorm, and they're already covered under your association package or package of coverage. Now, to monitor it, you can require the unit owners to present it to you either annually, monthly, and then you can follow up to confirm that all the policies are in place. And in the event they're not in place, you can pursue it just like any other breach of the governing documents. It gets a little costly sometimes, these types of scenarios, but at the end of the day, the unit owner for any potential negligence claim is responsible for whatever incidents that they cause, whether that incident is a leak stemming from their unit or something associated with damage within their unit. That is not necessarily the association's responsibility. And so you can pursue it against them personally anyhow.
Okay, Andrea, Patty in Boca Raton is asking, when is Citizens an option, and will they write policies on properties valued at more than $20 million? Explain what Citizens is so everybody understands that first, please.
Sure. So Citizens is what we refer to as our market of last resort. So it's got your state backing program so that when no one who's left in the traditional marketplace is willing to provide coverage, you go to Citizens. And even then with Citizens, you still have to jump through hoops. You still have to show your roofs have life expectancy and you have to qualify, and there'll be certain limits for coverage. To be eligible for Citizens, at the very least for condo associations, you have to prove that there was no other carrier within 15% of the premium who was willing to offer terms. So that, if you've got somebody who can offer it for 50% more, you've got that option there for Citizens to keep it financially viable. The 20 million is going to depend on the type of building. So if you have, $21 million buildings versus towers, depending upon how you're structured as a 718, 719, or 720. So that question I would have to get with her specifically to get some more details.
Okay, thank you. And Paul in Naples wants to know, how often does FEMA remap flood zones?
A lot more recently than they used to. So 2017 was the last major remap, but right now they're actually redoing an entire rating program, which is Risk Rating 2.0, which came out in October. So while it's not changing the zones themselves, it is going to be changing the way that they rate for the flood insurance. So you'll see some big difference there. But every few years, there's usually going to be a remapping done.
Okay, and Darrin, I'm going to ask you this question first so I can see Andrea's response. How necessary is umbrella coverage? And that's coming from Linda in Naples.
It's a requirement. So I hope that answers the question. Look, all the policies have an amount that what the policy amount is. And in the event that whatever the claim is exceeds your policy, you should have some sort of backup associated with that, just because damages could arise that exceed your policy amount. I think it's incumbent upon all boards to get it. I think an umbrella policy that's tied to all your policies isn't necessarily as much money as some of the other policies, and for the amount of coverage that you will have, I think it's a requirement. I tell all my clients it's a requirement.
So what we typically see is you're required to have general liability coverage. And so the GL coverage, we oftentimes see between $1 to $2 million per event. So that if it blows past that, some event blows past the $1 to $2 million, the umbrella policy kicks in. And we often see that between $15 to $25 million, depending on the property and the size of the property. So that's what the umbrella policy is there for, is to be a backup if something tragic happens at your community and you need something beyond just the general liability.
Yeah, and nowadays everything seems to exceed $1 or $2 million.
Yeah. So this is kind of an interesting question, Darrin. I'm going to bring it up to you. What protection does a property manager have if there's a lawsuit and the board initiates a counterclaim? This is coming from Valerie, who must be a manager, and she didn't mention if she works for a management company or it's self-managed. So what kind of protection does a manager have based on certain decisions that board members are making?
Well, it depends. Let's just say Valerie works for KW, and KW contract with the association, there's an indemnity clause where if Valerie was working in her capacity as a property manager that gave rise to the claim, Valerie would be indemnified by the association through its carrier for that particular claim. Likewise, and I can't say this for certain because I don't know entirely the nature of the claim, but if the nature of the claim gave rise to what we mentioned, breach of fiduciary duty or breach of the declaration, or general liability claim as a result, and that pursued it, and she was named personally, most likely as an agent of the association, she would also be covered under those policies as well. Assuming that she was acting within her agency capacity for the association, because really the manager is a stem from the board and acts as a agent for the board of directors. And hopefully that she's covered under an indemnity clause associated within the management contract and or the declaration.
Okay.
Could potentially trigger an insured versus insured exclusion under some directors and officers policies, depending upon what the counterclaim is. If the counterclaim is from the board back at the manager, there could be a potential exclusion of coverage under that scenario, just for something for them to be aware of. But to Darrin's point, at the end of the day, it's all contractual. The policies are contractual. The agreements with the managers are contractual. So what did you agree to begin with?
Right. But yes, the exclusion does come about it. We've seen that.
So last question for both of you, since we've drifted past 5 after the hour. We thank you so much for your time. Andrea, what would you recommend to people based on D&O insurance for a best practice as far as ensuring that you've got the right coverage for your community and to give board members peace of mind?
Sure. If I'm serving on a board, and I have in the past, that is my first and foremost. I'm taking the most time to sit down and evaluate what kind of coverage is being put into place. Premium is usually the last thing you should be looking at. That's the selfish answer if you're serving on the board. The answer toward the association is, if your governing documents are going to require the association to indemnify the board for their decisions, and you buy a policy that doesn't afford them coverage, then you as a community are going to be on the hook for it. So to protect the community, it's best interest to buy the broadest coverage you can possibly buy with the broadest terms you can. So I would be in there to understand all the different carriers, who the markets were that were available, and highlight the differences between them and make the decision from there.
Thank you. And Darrin, same question. What would your recommendation be?
Well, if you can get the broadest coverage, that would be ideal. If not, my advice would be just to be well informed as the type of policy that you can get. And I know that's hard because of the size of the stack of papers that policy will that policy contract is, but ask questions, try and review it. Obviously, you may not have time to look through it. Ask somebody else, maybe your lawyer for your association, to say, where are the particular trigger points that coverage would be excluded, and where under this policy do you foresee the association potentially having coverage issues? Just being informed is obviously the critical component to it, and also ask your agent too. I think it's incumbent upon the agents, as we mentioned earlier in this, to be forthcoming relating to all the circumstances that could impact coverage, as well as payoff of a loss. And so those are the two issues that I would or two recommendations that I would have relating to it.
And I would just say that I think agents work very hard to protect the associations. And if I recommend anything, it would be spend more time understanding what's going into your policy and what you're getting, as opposed to how to file the claim after it's too late. So
Agreed.
Early, talk to your agent, get the coverage that is best for your association based on the way it's constructed, and cost being not the most important thing, but coverage being the most important, because there's not that much difference between a policy that is worthless and a policy that actually gives you really good coverage. So understand that. Just like we always say, talk to your attorneys, make sure your attorneys are involved in reviewing contracts, bring your agents in early, talk to your agents. Don't let it happen the week of the renewal and then say, gee, I need to call my agent or make sure my agent gets my policy renewed. Do this 90 days out at least, so that you have the opportunity to have a good conversation, understand what you're paying for and what you're getting for your association. So That would be my recommendation. But I want to sincerely thank all of you who found time to tune in today. And a special thanks to our panelists, Andrea Northrop, Vice President and Partner with Insurance Office of America, and Darrin Gursky, partner and co-founder at Gursky Reagan Law Firm. Just so you all know, this session has been recorded. You'll get an email tomorrow if you didn't listen today, or if you did, you'll still get this. Feel free to share that email with other board members if you think they can get value from this, or you have to at least prove your point that you were right to one of your fellow board members. Send this to them and make sure they know about it. You can find us at kwpmc.com or our YouTube channel, which is KWPMTV. We look forward to having you join us again next month, which will be 2022. We're all at the end of the 2021. A new year is upon us. So from all of us at KW Property Management Consulting, be respectful to your neighbors, stay healthy, and happy holidays, everyone. Thank you so much.
Take care.
Thank you. Thank you, Tim.
Thanks, Andrea.
Thank you, Andrea. Good to see you.
You as well.